Good evening to all of you. On an average, the students who live in Mukherjee Nagar, they get monthly pocket money around 10,000 rupees. What about if their parents start sending 1 lakh rupees in a month? Don't you think they will stand and make a queue before the shops like mutton and chicken and in front of their dairy shops to get the paneer or whatever they are purchasing? I want to make you understand that if they are getting such a huge amount of money, they will generate a very high demand in the market for which the market is not prepared. And this high demand ultimately generate a compulsion upon the shopkeepers, and what they will do, they will increase the prices of the limited products, and this will be the reason of the inflation in the market. Every economy in the world has a certain absorption capacity of the currency. Therefore, to get rid of this kind of a problem, Reserve Bank of India designs the monetary policy. And this monetary policy is a very significant tool in order to control the inflation in India. This monetary policy can be divided in two parts, because there are two tools, you can say, which are used in order to control the inflation. The one tool that is quantitative in nature, quantitative, and the other one is qualitative. In quantitative, as you yourself have discussed, the things like CRR, SLR, bank rate, marginal standing facility, these kinds of things are there. And in the qualitative measures which are used to control the inflation in the economy are the the moral Suzanne. Moral Suzanne, it is also called moral pressure. Any other qualitative measure? Selective credit control. Selective credit control. And one more thing is there, I will discuss. So how these two tools are used to control the inflation in the market, so that the students who were getting earlier 10,000 and started getting 1 lakh rupees in a month, how that problem can be resolved, we will be understanding in our today's lecture. So the quantitative is, as far as concerned, the very famous term that is called CRR. CRR, cash reserve ratio. This cash reserve ratio, the problem arises from where? When the student got 1 lakh rupees. So how to control? I mean, what should we do so that a student could not get that 1 lakh rupees? And this will be controlled in a national level by the RBI. RBI will not control the students. RBI control the parents of the students, because their parents are getting the money from somewhere. So the change will happen from the top. So this CRR, which stands for the cash reserve ratio, this CRR is a certain proportion of the deposit of a bank which has to be deposited to the Reserve Bank of India. If you are an owner of a bank, and your bank has 100 rupees deposit, then a certain proportion of that deposit you will have to deposit where? To the RBI. Why you have to deposit to the RBI? Because it is the responsibility of the RBI to safeguard the interest of the people who have deposited. Who knows? Tomorrow you are running from the country like Vijay Mallya and Nirav Modi. Then who will be responsible? RBI, because RBI has given the license to the banks to run the business. So it is the responsibility of the RBI. That's why RBI has designed this kind of policy. You are opening the bank, then you have to deposit a certain proportion of that deposit to the Reserve Bank of India. That is called the CRR. Cash reserve ratio, because it is in cash, that's why we call it cash. And maximum it can be how much? Maximum it can be 15%. 15%. So if you have 100 rupees, you are a bank here, if you have 100 rupees, so RBI can have 15 rupees from that 100 rupees. So you try to understand that the money which is in the country is somehow getting absorbed by the RBI. So the money will remain less in the market. When the money will be left less in the market, then don't you think it will somehow control the inflation? Because the more money, the more artificial demand will be there. And as I have told you that every economy has an absorption capacity of the currency, that's why RBI has introduced this CRR. But RBI thought that this much is not sufficient. This much is not sufficient. There are so many customers and their interest is on the top. So one more term is there, that is SLR, statutory liquidity ratio. The same thing, but here what happens that the word statutory liquidity ratio, the cash is not used anywhere, but it does not mean you cannot deposit the cash. You can deposit the cash, you can deposit the gold as well, and any other legal security. Security. So statutory liquidity ratio, it is also a certain proportion of the deposit of a bank which remains with the bank, as opposed to the CRR which goes to the RBI. It remains with the bank, and that money cannot be used to give the loan. The maximum SLR can be how much? 40%. So you can say, means if you have 100 rupees, so 55 rupees cannot be given as a loan. Although it is not to the RBI, you cannot use it to give to somebody a loan. And CRR, it is to the RBI. So I mean this 55 out of 100 cannot be 40 plus 15, 55 cannot be used. So I mean, just think, more than 50% money is in the control of the RBI. The remaining how much? 45. RBI told that even this much is not sufficient for me. And he asked the question to the bank that what will you do to this 45 rupees? Okay, 45 rupees. So bank told that I will give it to my customers as a loan, and I will earn the interest from it. So RBI told that, why are you giving loan to the customers? I am here, you give loan to me. I will take loan from you. And that thing is known as the reverse repo rate. When RBI takes loan from the bank, okay, short term loan, when the RBI takes loan from the bank, we use the term reverse repo rate. I am telling that this reverse repo rate, when RBI will suck the money from the system, from the bank, the amount of money will be comparatively less. Because more the money, more the possibility of the inflation. So RBI is sucking the money somehow through CRR, through SLR, and through triple R as well. Because ultimately the objective is to control the inflation. And you can control the inflation if you are sucking the money from the system. Because when the money will be left less, then what will happen? The sellers, they will think, oh yeah, no one has money. Okay, let's reduce the prices of my product. Otherwise, who will purchase it? But if everyone is going with 1 lakh rupees into their pocket, then even a samosa wala will increase the rate and he will sell it in 1000 rupees. When he will get to know that now the students have got 1 lakh rupees pocket money, which is more than the amount of an IAS officer's salary. So this reverse repo rate, this also absorbs the money from the banks. Now the question is that why bank will give money to the RBI? Because you are a bank, you are giving a loan to a customers and getting the interest rate of 12%. Then why will you give money to the RBI in 6 to 7%? Why? Because RBI is a prime borrower. RBI is a prime borrower. You have authenticity. You know that my money will go nowhere. It is safe. But when you are giving money to somebody, to a customer, you are not as sure as you are sure in case of RBI. He may be defaulter, like Nirav Modi and Vijay Mallya. Then what will happen to you? So you have this kind of sense of security. That's why what happens, that a certain proportion of that remaining 45, you also become ready to give to the Reserve Bank of India. I'm not saying you will give all of the money, but a certain proportion. Why? Because you think with RBI the sense of security is more than anywhere else in India or in the world. So just see how the RBI is absorbing the money. The just opposite of the reverse repo rate is the repo rate. Repo rate, because it is not necessary all the time inflation will be there. Deflation can also be there. So in that situation, the RBI has to release the money. RBI has to release the money. I mean, the banks will take the money, and if RBI is not ready to give the money, he may increase the reverse rate so that it could be costly for the banks and their demand could be controlled. So these are ultimately, you have to keep in mind that how to play with the present money in the system. If inflation is there, you have to get it somehow and place within the Reserve Bank of India, and if the deflation is there, then you have to release the money. So CRR, SLR, triple R, RR, one more term is there. bank rate. Bank rate. By the way, could you tell me nowadays uh, which one is being used maximum in order to control the inflation? CRR is being used to control the inflation, or these are used to control the inflation?
Sahi.
Hmm?
Sahi.
This CRR is not used as frequently as the repo rate and reverse repo rate are used to control the inflation. You may be thinking why it is so. So I am giving you the logic. Actually, when the CRR, okay, cash reserve ratio, it was published in the newspaper that, by the way, it is a little older news, that continuously for 3 years CRR was not used to control the inflation. The reverse repo rate and only these tools were sufficient enough to manage it. And you need to understand why. Actually, look, CRR, cash reserve ratio, the RBI will ask, if RBI is increasing this rate, okay, 15 to let's assume 20%, then what will happen? Less money will be left to the bank. And when the less money will be left to the bank, banks are here for what? To get the profit, to generate the profit. So what will they do? Don't you think they will increase the interest rate to the customers? Because ultimately they are here for the profit. And RBI has already taken the money through CRR. So what will they do? That the remaining money will be used as a with more interest rate to the customers, so that bank could get a certain proportion of the profit. So if CRR is being increased, I want to make you understand that if CRR being is increased by the RBI, there is always a possibility that the bank will also increase the interest rate of the loan which is giving to his customers. And RBI cannot say that, oh, please decrease the interest rate. Because bank will say that what can we do? You have increased the CRR, so it is our compulsion. Otherwise, how our infrastructure, salary, staff, and all things will be managed? It is your compulsion. So in this case, that's why I'm saying why CRR is not used to control the inflation. If CRR is used, then bank will increase the interest rate. There is always a possibility of increasing the interest rate by the banks. Now, in the second case, in the repo rate, in these cases, what happens that if RBI is increasing these rates, in this situation, what will happen? That bank can say that, look, you cannot increase the interest rate when I am taking the money through which one? Triple R. Because in this case, the RBI takes the money, short-term loans from the banks. So here, when bank was taking the loan, RBI was asking to increase CRR, bank were increasing the interest rate. Here, when RBI is using or getting the money through triple R, and if in this situation banks are increasing the interest rate, then RBI will say that why are you increasing the interest rate? I am giving you the interest rate. I am giving you the interest rate, and you also have the account called current account. RBI will ask that you have current account, you tell me, do you give any interest to your customers who is a current account holder. So bank doesn't provide any interest to his current account customers. So I just want to tell you that RBI will use this logic like, look, if you are not giving the interest to your current account holder customers, then why are you expecting the same thing from me? Okay, so this is the main reason why CRR is not used to control the inflation, and why the repo rate and reverse repo rates are used to control the inflation. The way bank does not provide to the to its interest rate to its customer current account customers, in the same way you can say that RBI will say this thing to the bank, that the way you are not giving, so you don't expect this thing from me. Okay, but in this case bank RBI cannot say. Now the bank rate is there. Bank rate. So this bank rate, look, repo rate and bank rate, they both are same in one term, that they both are used by the bank to get the short term loan from the Reserve Bank of India. This is the similarity, but the difference is there that when the bank takes money by using repo rate, bank has to deposit some securities. Without security, the money through repo rate cannot be achieved by the bank. Whereas in case of bank rate, you don't need to place any kind of security. There is no any requirement of the mortgage. Some other differences are also there. And nowadays bank rate has become completely obsolete, you can say. Okay, so one more thing is there, that is marginal standing facility. What is this marginal standing facility? This marginal standing facility is a method to get the loan which is for 24 hours, when the bank is in a very critical situation sometimes, and this thing is not very much entertained by the RBI, because RBI never thinks that bank should reach in a critical situation, because reaching bank in a critical situation, it means losing the confidence of the customers, and ultimately the price has to be paid by the RBI. So RBI never entertains this kind of situation. RBI always tells that you please maintain your balance sheet, less NPA and all those things. But there are some circumstances when the bank requires the money in a very short time period, and that time we use the marginal standing facility. This is for 24 hours. That's why the banks always use this MSF money on Friday, because Saturday and Sunday is holiday. Yes. Okay. And the maximum amount of money through MSF, bank can get how much? 1% of NDTL. 1%. 1% of NDTL stands for net deposit and time liability. Net deposit and time liability. What is this net deposit and time liability? I'm not going to discuss it right now. Okay. So 1% of NDTL. I will explain it in a certain lecture, because I will have to tell 2 or 3 things and your concentration may get diverted. Okay, so always the money is taken in either 1 crore, 2 crore, 3 crore, in crores. The minimum is 1 crore. So in this proportion, the money can be assumed by using this MSF facility. Now let's talk about qualitative measures. Qualitative measures. So these qualitative measures, this is moral suasion, selective credit control. Okay, selective credit control is what? Selective credit control, basically Reserve Bank of India gives some guidelines to the banks that look, there are certain sections which require the money more than a business community, because bank always wants to give loan to those people who have the capacity to repay it. Bank will never give or will never be ready to give loans to the farmers, because bank is aware that we don't know the rain will take place this time or not, and if rain is not taking place, then what we will do if the crop is not happening? How much we can pressurize to a farmer? So bank as a business entity never entertains these kinds of people to give the loan. But RBI knows that this is the intention of the bank. That's why RBI has given a guideline that a certain proportion of the deposit has to be given by the bank to a particular section. That may be in the field of agriculture to the farmers, or that may be in any other field. I just want to tell you that bank signifies or decides that proportion of the society, and that becomes the compulsion of the bank to give that much amount of the deposit as a loan to that particular section. If this provision were not there, I don't think those people would ever get the loan by the bank, because bank always targets the prime borrower. So this is selective credit control. One more thing is there, that is marginal requirement or margin requirement. Margin requirement. What is this margin requirement? Margin requirement you can understand with the help of example, and let's assume you have a house. Okay, the cost of that house is 1 crore rupees. 1 crore rupees. You are going to the bank. And because you want to start a new business or something, so you went to the bank and mortgaged your house in order to get the loan. What bank will say that, look, I can give you only how much? Let's assume 60 lakh rupees. 60 lakh rupees. This is the first situation. In the second situation, bank is saying that, okay, I will give you 80 lakh rupees. So in the first situation, what is the difference? The difference is 40 lakh. And in the second situation, the difference is 20 lakh. Am I right or not? 40 lakh and 20 lakh. This amount is known as the margin requirement. Okay, margin requirement. In which case the margin requirement is more? In the first case, when the 40 lakh is there, actually what happens when the situation of inflation is in the market, when the situation or market is going through with the inflation, at that time the margin rate always remains high. The margin rate always remains high. What does it mean? You will get less money or less return against your house when the inflation is there. And this is the objective of the bank. Because in inflation, no any institutes wants to give a huge amount of money. Because in inflation, we want to suck money as much as it is possible, as it is being done by the RBI through CRR, through SLR, and through RRR, and all these measures. So in the same way, when the inflation is there, at that time the margin requirement will be high. The margin requirement will be high means you will get less money against your house which was valuing 1 crore rupees. And when you get less money, at that time the demand of the loan will be less by the people. The demand of the loan will be less by the people, and this is the ultimate desire of the RBI. Because less the demand of money means less money will circulate into the economy, and this will be a great measure to control the inflation. And when the situation is, when you are getting, when the margin requirement is less, it means the inflation is not in the market, the deflation is there. The last is the moral suasion. Moral suasion, it is also known as the moral pressure. And these are nothing but the guidelines of the Reserve Bank of India, which are supposed to be followed by the banks, which sometimes are ignored by the banks. For instance, a person took the loan from the bank and he purchased a four-wheeler. Due to some circumstances, the person is not able to pay the EMI of a particular month. In that situation, the legal procedure is, or let's assume continuously he is not paying the EMI, as COVID came, or during this situation we experience these kinds of things. So in such circumstances, what happens, sometimes the bank officials, they go to the person who has taken the loan, who purchased the car, and they will directly talk to him this and that and pressurize him. I am not saying you cannot go to the person, but the matter reached to the court, and court, because look, there is a procedure. The procedure is, you cannot go to the person who has taken the loan as long as you are not getting the NOC or the authority or the permission from the court. If you are not taking court here in the medium, you don't have any right to go directly and pressurize him. RBI is saying that please follow the ethical norms, the moral norms, so that we could generate a good impression in the society and also before the court. Because if the proper procedure is not followed and the matter is going to the court can cancel the license of the bank, for which, and these all things are taken care by the Reserve Bank of India, because Reserve Bank of India is the ultimate authority which gives the permission to the bank. So my conclusion is that the moral norms, those are written on the books, are supposed to be followed by the officials of the bank, not only with respect to in this four-wheeler case, but whatever things are coming before you, whatever matter you are dealing, you have to always take care the moral norms as well. That's is known as the moral Suzanne. So these were the quantitative and qualitative. One more thing which I am forgetting, and that is the open market operation. Open market operation. Open market operation is also very simple. It is used by the Reserve Bank of India. The only difference is there that these are the preventive measures. Okay, these are the preventive measures. The open market operation starts once the problem arises. When the problem comes in the existence, at that time RBI issues the securities, and these securities are purchased by the banks, because ultimate objective is what? Somehow to suck the maximum amount of money so that the inflation could be controlled. So through this open market operation, the securities are sold by the Reserve Bank of India, so that Reserve Bank of India could the excess amount of money out of the system, and inflation could be controlled. So this is the open market information, where the securities are sold once the problem comes into the existence. So these were the qualitative and quantitative tools. You need to understand that why CRR is not used, and why RBI is using these things to control the inflation in most of the cases. I have explained, but if there is some a problem in understanding, I will explain it again in my next lecture. Namaskar.